Hello and happy Friday, June 24th. Companies have a number of ways in which they return capital to their shareholders. Today, I'm going to talk about two of the more popular ways that have been used in recent years. These are cash dividends and stock buybacks. The graph beside me shows that both dividend distributions and stock buybacks have set new all-time highs approximately 2 years after the onset of the COVID-19 pandemic, as measured by the S&P 500 index. For comparative purposes, I'm including the dividend distributions and share buybacks for the past 8 quarters. As you can see, the company's clearly spending more on stock buybacks than dividends. The all-time high for the S&P 500 index quarterly dividend payout was $137.6 billion distributed in quarter 1 of 2022. And the record for quarterly stock buybacks was $281 billion registered in quarter 1 of 2022, according to the data from the S&P and Dow Jones indices. Overall, the companies of the S&P 500 index are flush with cash, as measured by the S&P 500 Industrials cash and equivalents. Cash holdings totaled $1.7 trillion on March 31st of 2022, which matched the $1.7 trillion held on March 31st of 2020, the onset of the COVID-19. Now, why is this important in these uncertain times and market volatility with talks of bear markets and recessions? Well, these companies are in a position of strength moving forward with a lot of options at their disposal to utilize these cash reserves. Past performance does not always correlate with future results, but a good balance sheet, cash on hand, and returning money to shareholders is a key indicator that drives success. In the case of stock buybacks, they offer much more flexibility. Initiating or increasing dividends is a long-term commitment, while share buybacks are a one-off tool that can be implemented by management. The main goal of any share repurchase program is to deliver a higher share price. The boards of these companies feel that their shares are currently undervalued, making it a good time to buy, ultimately believing they will go up in the future. Lastly is tax efficiency. Dividend payments are taxed as income, whereas share values are not taxed at all. Any holders who sell their shares back to the company may recognize capital gains tax naturally, but shareholders who do not sell reap the reward of a higher share value at no additional taxes. Now, if you think about it, this might sound a little familiar. If you've ever had a meeting with Don or myself, what do we always preach? Flexibility of investment strategies, long-term investing timelines, and of course, tax efficiency. Thanks for listening and have a great weekend.